Welcome to your monthly market report for October 2025. I am Adam Hopkins, and I'm thrilled to be here with you today because we have three really important topics that we're going to cover today. The Fed, forecast, and the future of real estate. So we're going to dive right in and share some slides with you because these are going to answer some of the biggest questions that are on yours and your clients' minds right now. So first of all, everybody wants to know what's happening with the Federal Reserve, what's going on, and what does this mean for the forecast, especially for the housing market, and what do we see coming around the corner in the future? Those 2026 expectations. So we're going to start today by kind of giving you an overview of where we are in the housing market right now. There's a lot going on. I want to start with what's happening with inventory. The number of homes on the market continues to rise. So this is actually the fifth consecutive month that we've now seen in inventory with active listings over 1 million. So there's a lot more inventory on the market, 20% more inventory on the market today than there was this time last year. Now, you know this isn't news to you, but it certainly is something that has changed in the housing market. So in fact, with more inventory on the market, we're starting to see a lot more price cuts among sellers. In fact, 20% of all listings are now cutting their prices to get in line with market expectations. One of the biggest disconnects that sellers are having right now is trying to price their homes based on their expectations of what happened just a few years ago. And the landscape truly has changed, and there's a lot more inventory now than there was previously when homes were selling much faster. As homes are staying on the market longer, sellers are having to make more price cuts. So being able to share these facts and show them these visuals, if you are a real estate professional working with clients, especially home sellers, these visuals are going to be really helpful for you to set proper expectations in order to best serve your clients. So please keep this in mind. Now, it's the facts that matter so much right now. And with more inventory and more price reductions on the market, what is that doing to home prices? Well, home prices are starting to moderate much more. So we're starting to see home prices not accelerating like they did just a few years ago. Home prices are still growing nationally, but the pace is a lot smaller. Here in Central Virginia, 2%. We're seeing 2% home price appreciation year over year from this time last year. And as you can see from this graph nationally, that is also true, 2.3%. It's a lot less appreciation than what we've seen in years past. So home price growth is beginning to slow and normalize, even though it is continuing to rise nationally. Now, historically, 3 to 4% is typical. That's a typical year-to-year appreciation when we look back over the last 100 years. But that does vary market to market. In fact, this quote right here is from Realtor.com. That does says, while national prices continue to climb, local market conditions have become increasingly fragmented. This regional divide is expected to continue influencing price dynamics and sales activity as the fall season for 2025 gets underway. So, how does that translate to what we're talking about right now? Well, what we're showing you right here is that home price trends do vary by area. We're looking at the top 50 metro areas in this graph. About half of them are still seeing price appreciation. Prices are going up. We're seeing rising inventory throughout the country, so there are more homes coming on the market, but in those places where prices are still going up, the inventory is still tight. Now, on the other half of the country, we're beginning to see prices start to decline a little bit. And when we look at this, we know that some of those markets where prices are coming down more than others are also the ones that had the bigger price appreciation several years ago of 60 and 70%. So there's a little bit of a correction going on. And when we look at this graph, I don't want you to worry that the bars for all 50 markets are going to turn red, because that's most likely not going to be the case. Based on historical data. I don't want you to freak out about this, because that's not what we're looking at right here. I'm going to explain this to you. So the bottom line is that inventory is having a big impact on pricing. So we're seeing more price reductions and price growth is slowing down. And that's just generally the state of the market right now. And so when your clients are hearing about all of this, it can be confusing. They're not sure what's happening. But one thing I can tell you is that now more than ever, your knowledge as a real estate professional is powerful. And I say that because it's really important that you understand what's happening nationally and locally so that you can explain what's most important to your buyers and your sellers. And if you're able to articulate this, that's going to give you the power, it's going to give you a powerful place in this market. Because on one hand, we have this housing market looks very different than it did a few years ago. But if you're familiar with what's happening now versus what happened before and why all those dynamics were taking place, and we're able to educate our clients about it because they're not sure what all of this means. By being able to do this, it's going to put you in a great position to educate them to make the best decisions for their goals to meet and achieve those. And you're going to be the one to be able to help them do this. So, what is ahead for the future? What are the forecasts looking like? And honestly, what they're really wondering, what our buyers and sellers, what our clients are wondering is when mortgage rates are going to come down. And what does this mean for affordability, especially if someone's thinking about buying or selling? So when our clients are unsure about all of these things and they're unsure about what's happening in the economy, being that expert who can bring the facts and knowledge and explain all of this becomes mission critical for your clients and your business. So I want to talk to you guys a little bit about these three things: the Fed, the forecast, and the future. Because we know where the market is. Now let's talk about what's happening and where it's going, because I genuinely believe as we get into 2026, there's going to be this slight breeze at our back, finally. And the market is going to make this gentle turn right now. It's not going to be drastic, but we're definitely beginning to see signs of life and signs of things that there are changes coming into our different markets. So let's start with the Federal Reserve. Everybody's saying, hey, what is the Fed going to do? Well, let's remember that the Federal Reserve, they do not set mortgage rates. People want to know what's happening with mortgage rates, but that's not actually what the Federal Reserve does. They set the federal funds rate, and then they set the federal funds rate, and that when they make a move on the federal funds rate, when that moves up or down or holds steady, that's a reflection of the broader economy. And there's several things that the Fed looks at to make those decisions. Now, what they're trying to do is avoid recession. And what happens in this process is that mortgage rates tend to respond, whether it's leading up to or just after the Federal Reserve meeting. Mortgage rates and the markets tend to respond to what the Fed is saying about the broader economy. And we know they have what's called a dual mandate, two mandates. Now, there are two things that the Federal Reserve is responsible for. The first is price stability. So they want to make sure that prices aren't rising exponentially, like we see in this graph with inflation, like they have in years past. And the second thing is they want to make sure they have maximum employment. They want to make sure that people have jobs in this country. So they look at a lot of different things to help manage this dual mandate. So let's look at the first thing that they're watching: inflation. And right now, inflation remains slightly elevated. So it's a little bit higher than their goal of 2%, but it is starting to stabilize. We're seeing that stability over time. And so the Fed's keeping their eyes on this for sure. Now, what they're also looking at is they aim for maximum employment and this is reflected in the unemployment rate. Now, unemployment is holding steady, again, a little bit higher than what they're looking for, but you can see consistently it is holding steady. So they're looking at these two different things, trying to decide what's the correct next move. But there's one thing that kind of impacts the employment side that I think is kind of rising to the top right now, and it's the bigger issue, and that's the job growth is stalling out. So when you look at this graph here, you can see those orange bars. You can see these orange bars to the right of your screen, and that reflects that we're not adding that many jobs to the economy right now. So as they're trying to manage this dual mandate of maximum employment, price stability, and avoiding recession, they're looking at all this different data to make those decisions. And it's going to make it a little bit tricky in the next several weeks. So we're recording this in the middle of October. We're actually in the middle of a government shutdown. Now, we don't know how long the shutdown is going to last, but it could be a couple of days. It could be a few weeks. It could be over by the time you're watching this. We just don't know. But what we are sure of is we're keeping our eye on it because it means a couple of things for the market. First of all, this data that the Fed is looking at might not be available as it has been in typical times. So if they're looking for unemployment data that isn't going to be released, they're going to have to look at other factors. Now, it's also like I said, we don't know how long this shutdown is going to last. So it's going to be a challenge for them to make decisions based on what they know. They have to make decisions based on what they know and based on trends. So the federal shutdown could be over, like I said, in tomorrow, today, but if it draws out longer, it could impact these decisions if it does last longer. Okay, so the next thing that it's going to impact is mortgage rates. How do the markets react? How do the financial markets look at this and what happens? We don't know how this is all going to pan out. So we're going to keep our eyes on it. But all these things are kind of swirling around right now and kind of have an impact on the Fed's decision moving forward. Now, this quote from NPR discussing the Fed faces another rate setting decision in 4 weeks, and policymakers would like to have up to date information on hiring and employment. It's kind of hard to do that when the federal government is shut down. It's not that they can't do it, they just have to work a little bit harder to dig and get the information that they need to make correct decisions in terms of the federal funds rate and how that's going to impact the economy in general. So what are they thinking about the economy? And what are folks thinking about right now? What we know about this survey from Lending Tree on this slide is that people right now are worrying about a possible recession. Nearly two-thirds of Americans expect a recession is coming. And so when people are hearing this in the news and they're not sure, and it's very confusing, again, your clarity as a real estate professional makes a big difference because when people are concerned about a recession, they're not going to make big purchases. They're not going to be purchasing a home. They're not going to be buying a car. There's a lot of things that they're going to be putting on hold right now because they're just unsure. And 74% of Americans admit that world news and current events are affecting these purchasing decisions. So, really important to be able to step in and clarify for our clients what this really means, how it impacts the market, and how it impacts their decisions. Because ultimately, at the end of the day, people want to know, are mortgage rates going to go up? Are they going to come down? Or are they going to stay the same if they're thinking of buying or selling? This is top of mind for them right now. So again, the Fed is expected to make some decisions in the next couple of weeks to make more cuts this year. Maybe some again early in beginning of 2026. That's what the expectation is. Again, we're going to be continuing to watch this, but all of that is a reflection of what's happening with the economy. Now, with people having all of these questions on their mind, what's happening with the economy, what's going on? Like I said, one of the biggest things they want to know, especially in the industry, is what does this mean for interest rates? Does that mean that it's going to be more affordable to buy a home? What are mortgage rates going to come? Are they going to come down? So let's talk about what we see for the forecast. It's not so much the rate that matters, it's the affordability factor. The rate is simply a reflection of how affordable are homes for our home buyers when they're looking to make a move up. How affordable are the homes that a seller has on the market compared with the other options that buyers have to choose from, including doing nothing. So those are things that we really have to take an honest inventory of. So what we can see is that some of the top forecasters are saying that mortgage rates should end the end of 2026 somewhere in the low 6% range. Fannie Mae is already saying potentially 5.9. I mean, there's a lot of things that are going to happen between now and then, but based on what we're seeing in the data right now, what's happening in the economy, how the markets tend to react, we anticipate the mortgage rates are going to come down slightly going into next year. Now, again, this is part of that slight gentle breeze at our back that I mentioned a few minutes ago as we head into 2026. And it's really important for us to be able to, again, articulate and explain this to our clients and educate them to show them what we anticipate is happening again or coming up ahead of us. And in September, we saw the Feds begin their rate cutting cycle. So their cycle of making potentially several cuts to the federal funds rate. What we saw leading up to that was the market or the financial market saying, okay, we see this coming. We know this is going to happen. So it's a reflection of the economy, and mortgage rates actually started to go down ahead of that rate cutting cycle. Now, after that, they did start to creep back up a little bit. So when the rates eased to, I think it was about 6.2%, we saw a big jump in market activity. And then in the next 2 weeks following that, rates started to creep back up. And what happened? Market activity began to dry up. So there's going to be some volatility that's involved in this. And it's not always the Fed cuts rates and mortgages come down, as we just saw. But as they start this potential rate cutting cycle, forecasters are looking at this. They're looking at what's happening in the economy, how markets are reacting, and we're anticipating that mortgage rates should ease, which means they should draw back and come down in 2026. So that's definitely going to be something that bodes well for the housing market. It's something we are continuing to watch. And a lot of our clients are wondering this right now. How does this happen? How does all this work? Well, let me show you something to watch for as a good indicator. A commonly watched indicator for where mortgage rates are headed, and that is the 10-year Treasury Note. Because over the last 50 years, the 30-year mortgage rate has moved in unison, parallel with the 10-year Treasury Note. So what does this mean? When the 10-year Treasury goes up, mortgage rates tend to follow. When it comes down, mortgage rates tend to come down as well. And the average spread between these two benchmarks is generally 176 basis points, or 1.76%. Now, if you look at this graph, you can see we are outside of that window right now. So historically, it's 1.76%, and that's been the typical average for the last 50 years of this, we'll call it a symbiotic relationship. But let's zoom in and take a look at what's been happening over the past few years. This is kind of a closer look at the beginning of 2023 all the way to today. And what we can see is that gap between the 10-year Treasury and the mortgage rate has started to narrow again. It was at 2.76, now it's at 2.1. So that's not back to the normal 176 basis points, but closer to 2.6. And so as it started to come together, we often look at what is considered the measurement of fear in the market. So that spread is fear. So as clarity starts to come about this, and it becomes clear what direction the market is moving, the spread starts to narrow. When there is more fear and more risk, that spread, that gap begins to widen. And again, just think of rates. The best way to think of rates are risk assessment. The higher the rate, the bank or the lender is saying the higher level of risk. The smaller, the lower the rate, the lower the risk. So those who have the best credit scores, the best financial position tend to get the best rates. That's just the nature of the financial business. So back to our graph. We are looking at a spread of 2.1%. And as I said, that spread is supposed to come down a little bit in the coming year, as you can see here. Now, we don't know how much it's expected to come down, but the forecast does say a gradual decline. And again, this can change as economic data and reflects what's happening in the economy. And any shift is going to be reflected in these projections. So this is subject to change, which is why we watch it every month. But based on what we know right now, that spread or that 10-year Treasury is supposed to come down, which is going to narrow that spread. So let's play this out for a second. Imagine that the spread, we're going back to normal, right? So we're not in a normalized market, but we're heading in that direction. So if you look at where mortgage rates would be if the spread were normal, on the right side of the screen, you take the 10-year Treasury yield, you add the typical 176 basis points, you get mortgage rates that are closer to the magic number of 6%. I've been saying for years, 6%, 6%, 6%. That's where we need to be. And every time we inch closer to that, market activity picks up because it is a direct reflection of affordability for our clients that are looking to buy a home or sell a home in this market. So I'm not going to say that's going to happen tomorrow. I wish it would. But the way that the market is moving right now, it may take a little bit of time to get there. This quote from Samir Dadia, CEO of One Real Mortgage, with expectations growing for a rate cut at the Fed's next meeting. This could be just the beginning of a stronger housing market heading into the fall. Uh, let's see. So when we're going back into this, when we look at this graph here, it's a reflection of the lower rates equals stronger buyer demand based on the average 30-year fixed rate mortgage. So when you break this down, you can see that this white line across your screen, that the average 30-year fixed mortgage rate is right there in the middle. And over this past year, it kind of hovered in this limited demand zone where buyers were putting their plans on pause. They weren't sure, and they were sitting on the sidelines and waiting for rates to fall, waiting for affordability to improve. And what they saw in the end of August, early September, when rates came down, is the buyer demand kind of kicked into that good range rather quickly. So it's not massive demand. It's at this interest rate range, but we certainly saw activity increase. I've talked to so many agents and industry leaders who have been following along with this, and they're like, yeah, man, we definitely feel some momentum beginning to pick up as those mortgage rates come down. And that's just the nature of the game. As interest rates fall, the affordability increases, so people want to get into the market. So that's a really, really good thing. As we get into next year, we can expect demand to improve. And so as demand picks up, we're going to see more transaction. And what does that mean potentially for home prices for our clients? Well, this is the look at US home price expectation surveys, where they've surveyed about 100 economists, industry leaders, and people who look at this data and project out what they think home prices are going to look like over the next 5 years. And what we can see is they break this into three categories. So these three colored lines over here on the right, the optimists are saying home prices could rise nationally about 25% over the next 5 years. That's very optimistic. Now the average is closer to 15% over the next 5 years. Now I'll tell you where this number comes from. So probably, most likely we're going to be looking at somewhere in this 15% over the next 5 years. The average is closer to 15%, and historically, we're looking at a 3% home price appreciation per year. If you look at the last 100 years, typically you're looking at about 3%. That's in a normal, steady market. So 3% over 5 years, approximately 15%. So that's where that number is coming from. But what's interesting is when we look at this, even the most pessimistic outlook, we're looking at almost 4.9% or 5% over the next 5 years, which is just under 1% per year. We know that in the greater Lynchburg area, we're looking at 2% from this year over last year. So 2%, 3%, that's the most reliable number to look at. But even if you're a pessimist, which I think it's healthy to look at both ends of the spectrum and figure that we're going to fall somewhere in the middle. But I think that 2 to 3% appreciation per year is a very reliable number to be looking at. So that's definitely a good sign in terms of stability of the housing market. We're going to see that moving forward. So with the home price growth expected to continue with mortgage rates even slightly, and with mortgage rates expecting to come down, what does that mean for home sales? Well, if you look at the forecast for home sales for 2025 and 2026, this year we're expected to end about 4.8 million total home sales. So that's existing plus new construction sales. And next year it's expected to tick up a little bit more to 5.2 million, just over 5.2. Now that's not a big jump, but it's part of that gentle breeze we have at our back that should be translating into more transactions for our clients. We have more inventory. We're going to have more buyer demand because affordability is improving. And with the easing of mortgage rates and improved affordability, and as home prices are steady, all these different things swirling together should lead us to more transactions next year over this time here in 2025. And so that's something to certainly keep in mind. So if you anticipate more transactions next year, how many of these are going to be clients that we represent? That's the big question, because it's truly the work that we put in now that's going to set up our success for 2026. We know that the agents who are having the most conversations with our clients are the ones who are going to help more clients be successful. So the conversations we start today set the stage for our client success in 2026. The more of this knowledge and information that we are able to share with them, that is truly our superpower as we move into the new year. So our list of relationships, some might call it your database, your contact management system, whatever you call it. I call it my list of relationships. People who are out there who are confused, who want to understand what's happening, and they just need someone who has a grasp of all this to be able to break it down and explain it to them. That's where we come in to be able to help them make powerful and confident decisions regarding the real estate market and helping them achieve their real estate goals so that they understand the data, they understand what it means for them, they understand what they can expect moving forward. And that's where we can absolutely excel and increase our market share by simply helping more of our clients achieve their goals. Now, we we don't want to be waiting for the next 2 to 3 months before we initiate those conversations to help people feel better about buying or selling their home. We need to be having those conversations right now so that when they're ready to buy, they can turn to us. And I want to give you one fantastic example of an agent who found some awesome results having great conversations with their clients. So there was an agent who had shared this information about monthly payments are down by $290 in the last 4 months simply because of the easing of interest rates, making them more affordable. So they took this information, shared it with their past clients, which included some folks who were considering making a move, but they just weren't sure. But they were just silently sitting, waiting to hear about what's going on in the market. And so this agent reached out and shared this with them at a time that was incredibly helpful for them. And the result was awesome. So this agent sent 40 text messages sharing this information, had 18 meaningful conversations. They had 7 appointments and consultations meeting with their clients. And so far, they've helped one of those 18 conversations of 18 clients that they had spoken with. They were so far they've helped one out of that small number make that move. That if they had not been proactive in reaching out, then that client still would be sitting on the sidelines, wondering if now would be a good time to make a move. So these things can happen quickly, but it does require being mindful and proactive in the way that we reach out to our clients to help keep them informed, whether we're providing monthly CMAs, providing market information on the value of their current home, what's happening in the market, affordability, interest rates, all of those things are important. So all of this, just remember that at the end of the day, most agents out there know generally what's happening, but good agents really have an understanding and grasp of what's happening. But great, exceptional agents are able to break down and explain this data and the information in a way that can be received by our clients so that they can make those decisions to get them to that next level, to help them achieve their real estate goals for themselves and their family. And that's what we're here to do. So I appreciate you watching through this. If there's any questions that you have, if you'd like to put together some strategy or map out over the next coming months what you can do to make sure that you're really locked into serving your clients at the highest level, don't hesitate to reach out and let me know. Call, text, email, send up smoke signal, whatever works for you, and we'll do our best to get you squared away. As always, thank you for your referrals because you are the heart of our business, and we'll look forward to talking to you soon. All right, see ya.